Imagine making money not when the market is, shooting up in a frenzy or crashing down in a panic, but when it's just doing nothing much at all.
Yeah, like what if the real opportunity wasn't in predicting the next big move, but simply in betting on calm?
Exactly. That idea, it really challenges a lot of conventional thinking about making money in the markets, doesn't it?
It really does. And it's precisely that intriguing concept we're going to try and unravel today.
Okay, so today we're taking a deep dive into strategies designed specifically to profit from that market tranquility selling volatility in the U.S. options market.
Using techniques known as short straddles and short strangles.
And you've brought us, quite a stack of source material here. Academic studies, industry analysis, practical discussions from trading communities. It looks pretty comprehensive.
Yeah, we've tried to pull together research looking at, how these strategies actually perform, the mechanics, how they're built, the really significant risks involved, which honestly you absolutely have to understand. We've got historical studies comparing returns to simpler things like just buying and holding an index. Crucial risk management techniques, basically how to stay alive doing this.
Which sounds important.
Very. And even the often overlooked but really vital implications for your taxes.
Okay, wow. This is definitely a lot to get into, and it sounds like there's no simple yes or no answer here.
Not at all.
So our mission, I guess, in this deep dive is to cut through the noise, understand the core mechanics, weigh the potential rewards against those, very real dangers, and try to figure out if trying to profit from quiet markets is a genuine opportunity or maybe just a high-stakes gamble best left to the pros.
Well, it's definitely a strategy that demands a deep understanding of market dynamics and a really robust approach to managing risk. It's far, far from a simple set it and forget it kind of thing.
Right. You can't just dabble. So let's start at the beginning. We talk about volatility all the time in finance. For our deep dive today, how should we think about volatility and why on earth would someone want to be on the selling side of it? Okay,
so at its heart, volatility is really just a measure of how much an asset's price moves over time. It's about the magnitude of the swings.
So high vol means big, fast price changes. Low vol means things are pretty stable.
Exactly. High volatility, big swings, fast changes. Low volatility, prices are relatively stable, maybe moving in a pretty narrow range.
And the tool we're using to interact with this volatility is options. Could you maybe quickly recap for anyone less familiar what a call and a put option actually are?
Sure. So an option contract gives the buyer the right, and this is the crucial part, it's the right, not the obligation to either buy or sell an underlying asset.
Like a stock or an ETF.
Right. At a specific price, that's called the strike price, on or before a certain date, which is the expiration date.
Okay.
A call option gives the buyer the right to buy at the strike. You'd typically buy a call if you expect the price to go up.
Makes sense.
A put option gives the buyer the right to sell at the strike. And you typically buy that if you expect the price to go down.
Okay, so the buyer pays money, a premium, to get that right. Their maximum loss is just that premium they paid outright.
Correct. The premium paid is the most the buyer can lose. But their potential profit, well, if the market makes a huge move in their favor, it's theoretically unlimited.
Got it. And our focus today is on the person on the other side of that trade, the option seller.
Exactly. The seller receives that premium from the buyer right up front.
Okay.
And for the seller, that premium they collect, that's their maximum potential profit on the trade. If the options they sold just expire worthless.
Meaning the market didn't move enough or move the wrong way for the buyer.
Right. If they expire worthless, the seller just keeps that premium. That's the win.
So it's the complete opposite dynamic from the buyer. Receive premium, potential gain is limited to that premium. But, I feel a but coming, the risk side must be flipped too.
Absolutely. And this is the big one. While the buyer's loss is capped at the premium they paid, the option seller's potential loss is theoretically unlimited. Unlimited. This is, without doubt, the single most critical point about selling options naked, meaning without a hedge. And it's exactly why these strategies, straddles, and strangles carry such significant danger.
Unlimited loss potential. That's Definitely a heavy thought to start with. So given that massive potential downside, why would anyone choose to be a seller? Where does this betting on calm idea actually come from?
Well, it really stems from the way options get priced in the market. An options price isn't just based on where the stock is now and how much time is left. It also reflects the market's collective expectation of how much the underlying asset's price will move in the future.
Okay, so it's like a prediction baked into the price.
Exactly. This expectation is what we call implied volatility, or IV.
Implied volatility. So it's not about what the price has done historically, but what the market thinks it will do, like a forward-looking guess by everyone involved.
That's a great way to put it. It's a forward-looking bet.
Yeah.
And volatility sellers fundamentally are betting that this market expectation of future movement, the implied volatility, is actually higher than the movement that will really happen by the time the option expires.
And that actual movement is realized volatility.
RV.
Correct. Realized volatility, RV. That's what actually occurs.
Okay, so the seller makes money when RV turns out to be greater than RV.
Right.
The market was pricing in a bigger price swing than what actually happened.
Right.
And the option premium, which was kind of inflated by that high expectation, that high IV, it just decays away as time passes and the big move doesn't show up.
That's the core mechanism, yeah. Sellers are trying to capture and, well, monetize that difference. They collect the premium that reflects the market's fear or expectation of movement.
Oh, this is sometimes called harvesting the variance risk premium. Essentially, the market often seems to kind of overprice future uncertainty relative to what actually ends up happening.
I remember that horse race analogy from one of the sources. Implied volatility is like the market's collective bet on how fast the horse will run, factoring in everything, rumors, track conditions, you name it.
Right.
And realized volatility is how fast the horse actually runs the race. So a volatility seller is betting the market predicted a much faster race, more price movement than what actually unfolded.
Exactly. And they collect the premium that was paid by those betting on that faster, more volatile race. Now, why might this overestimation happen often enough to be a potential strategy? It kind of relates to how markets spend most of their time.
Oh, interesting. Tell me more about that. Is the market usually quiet?
Well, market data pretty consistently shows that significant sustained directional trends, big moves up or big moves down, they only happen about 30% of the time.
Only 30%.
Yeah. The vast majority, maybe around 70% of the time, the market is actually range-bound, moving sideways, or just experiencing smaller, choppy ups and downs.
70% of the time, the market is just hanging out. That feels really counterintuitive when you look at news headlines.
It does, doesn't it? But the data seems to support it. And this range-bound characteristic is incredibly important for option sellers because of something called time decay, or theta.
Theta, right, time decay.
Yeah, option premiums are made up of intrinsic value, that's how much of the option is already in the money, and time value. Time value is the value of the possibility that it could become more profitable before it expires.
Okay.
And as that expiration date gets closer, the time value just decays. It melts away and it accelerates really rapidly in the final weeks and days.
So if the price just stays relatively flat or bounces around within a range, the time value of the options you sold just evaporates. Poof.
Precisely. Time decay is the seller's absolute best friend in a quiet market. As the days tick by, the premium you collected up front just erodes from the options price, simply due to time passing.
Yeah.
That benefits you hugely if the price stays put.
I remember seeing that returns distribution graph in one of the sources. It showed this huge spike right around zero daily change.
Yeah. That vividly shows it a huge concentration of daily returns clustered really tightly around zero. That big central peak represents all those days the market barely moved. And those are prime conditions for volatility selling strategies.
That graph is compelling. It visually confirms that the market spends a disproportionate amount of time in that narrow band. And that's exactly the environment where time decay does its magic for sellers.
Mm-hmm.
Okay, so the basic strategy is collect premium based on expected volatility, IV, hope actual volatility, RV, is lower, and let time decay eat away at the option's value.
That's the essence of it.
And the specific strategies we're focusing on to do this are the short straddle and a short strangle.
Right. And these are often called non-directional strategies.
Because you don't need the market to go up or down for them to work.
Exactly. You just need it to stay within a certain range, more or less.
Okay, let's break down the short straddle first. How's that one constructed?
Okay, a short straddle involves selling both a call option and a put option.
Both?
Both. On the same underlying asset, using the same strike price, and both having the same expiration date.
Okay, same underlying, same strike, same expiration.
And typically you sell options that are right at the money, or ATM. That means the strike price is very close to where the asset is currently trading.
So if, say, the SPY ETF is trading at $450, you'd sell the $450 call and the $450 put for maybe next month's expiration.
Exactly like that. Your goal then is to profit if SPY stays relatively steady or maybe just bounces around within a tight range around that $450 strike. Yeah. You are explicitly betting on a lack of significant price movement.
Okay. And we already know the risk-reward profile.
Yep.
Unlimited risk potential if the market moves sharply in either direction. Your maximum profit is limited to the total premium you collect from selling both the call and the put.
Right.
And the sources are quite clear on this. They correctly highlight it as a high-risk strategy.
Yeah.
Probably best suited for experienced traders who really understand what they're getting into.
Let's use that Nifty example from the Indrapper source just to make the mechanics really concrete. If the Nifty index is trading around 18,000,
okay,
you'd sell the 18,000 call and the 18,000 put. Let's say the 18,000 call premium is 100 points and the 18,000 put premium is also 100 points.
Okay, so you collect a total premium of 100 plus 100, which is 200 points right up front.
Right.
That 200 points, that's your maximum possible profit.
Yeah.
And you'd achieve that if the Nifty is exactly at 18,000 right at expiration.
Okay, max profit at the strike price. Now, the crucial part, the break-even points. Where does this trade start actually losing money? Right. The break-even points are basically the boundaries, where your total loss from one of the options, either the call going way up or the put going way down, starts to exceed the total premium you collected initially.
Okay.
The formula, as the source states it, is the strike price plus or minus the net premium collected.
The total premium from both options.
Yes, the total premium. In this Nifty example, that's the 18,000 strike price plus or minus the 200 points total premium.
Okay, so the upside break even is 18,000 plus 200 is 18,200.
Correct.
And the downside break even is 18,200 equals 17,800.
Exactly. So as long as the Nifty finishes somewhere between 17,800 and 18,200 at expiration, you keep at least some or maybe all of that initial 200-point premium.
But outside that range?
Outside that range, you start losing money. And the further it moves beyond 17,800 or 18,200, the more you lose, potentially infinitely.
Right. Now, you mentioned the source had a slight inconsistency here.
Yeah, just a quick note on that. The specific example calculation provided in the text for the Nifty Straddle actually shows break-evens of 18,100 and 17,900.
Which is like 18,000 plus minus 100, not 200.
Right. That seems to contradict the formula they stated, strike plus minus net premium, and the total premium collected, 200. Right. Based on how options payoffs work and their own stated formula, the break-evens really should be 17,800 and 18,200 in that example.
Okay.
So it looks like maybe just a typo or an oversimplification in their specific example calculation. The key takeaway is the principle. Break-evens for a short straddle are the strike price plus or minus the total premium you received.
That's a really helpful clarification. It shows why you have to understand the underlying formula, not just blindly follow one specific example that might have an error.
Definitely.
And that payoff chart from the source, it visually represents this perfectly, doesn't it? Yeah. It's like a sharp peak right at the strike price that's your max profit zone. Mm-hmm. And then it slopes downwards infinitely as the price moves away from the strike in either direction, crossing zero profit at those break-even points.
Exactly. And the steeper that slope is outside the break-evens, the faster you lose money. It really highlights that unlimited risk aspect.
Okay. So when would be the ideal time to actually deploy a short straddle? When would you put this trade on?
Well, the ideal time is when you have a really strong conviction that the market or the specific underlying asset you're trading is likely to remain range-bound or just move sideways.
So low volatility expected.
Low realized volatility expected, yes. But interestingly, it's also a common strategy deployed before major market events.
Like earnings announcements or Fed meetings or elections.
Exactly. Because implied volatility, that phi-V we talked about, tends to spike dramatically leading up to these events. Traders buy options like crazy to hedge or speculate on potential big moves.
So the premiums get really expensive.
Very expensive. A straddle seller can collect those really high premiums from this elevated phi-V, betting that the actual move after the event happens won't be as large as the market is pricing in.
Okay.
And they also bet that volatility will then just crash afterwards once the uncertainty is resolved, which helps the options decay really rapidly.
I see. So you're selling that event premium, collecting the inflated price driven by fear or uncertainty, hoping the market reacts less wildly than expected, and then profiting as IV collapses post-event.
That's a key part of the strategy for many sellers, yes. Now, how does the short strangle differ from this?
Okay, good transition. Short strangle, walk me through that one.
A short strangle is similar in concept, betting on limited movement, but it uses different strike prices.
Okay, not the same strike.
No. You sell a call option with a higher strike price and a put option with a lower strike price, both on the same asset, same expiration date.
Higher call strike, lower put strike. So you're selling options that are further away from the current price.
Exactly. Instead of selling right at the money, ATM, like the Straddle, you're selling out of the money, OTM options. One call above the current price and one put below it.
So back to our SPY at $450 example.
Yeah.
Instead of selling the $450 call and put, maybe you sell like the $455 call and the $445 put.
Correct. Those would be typical OTM strikes for a strangle. The goal is still to profit from the underlying trading in a, let's say, relatively narrow range.
Right.
But the profitable range is defined by the space between those OTM strikes plus the premium you collected. It's also generally suited for stable markets where you expect low volatility. Although sometimes people use them when IV is really high because even OTM premiums can get quite juicy then.
And the risk-reward profile, still the same scary part.
Yep, still the same fundamental profile. Unlimited risk potential if the price moves dramatically beyond your break fence, with the maximum profit limited to the total premium you receive from selling those two OTM options.
Okay, so both are non-directional, both profit from call markets or lower RV compared to IV, and both have that unlimited risk hanging over them. Why would you choose one over the other? The source material gave us some comparison points.
Right. Well, the most obvious difference is the amount of premium you collect.
Because the Strangle uses OTM options.
Exactly. Because ATM options, which you use in a straddle, have the highest amount of time value. A short straddle typically collects a significantly higher premium than a short strangle, which uses OTM options that inherently have less time value.
Okay, so higher premium for the straddle means a larger potential maximum profit right off the bat.
Yes. And the sources also note that this higher premium received in a straddle provides a larger buffer. It potentially makes making adjustments to the trade easier if the market starts moving against your position compared to the thinner premium you get with a strangle.
Makes sense, more cushion.
Yeah. And the straddle, because it focuses right on that ATM strike with the peak time value, it's also generally considered more effective at capturing that time value decay, that theta burn, than a strangle using OTM strikes.
Okay, so for the straddle, better potential max profit, maybe easier adjustments, and more direct exposure to that peak time decay.
Yeah.
What about how sensitive they are to price movements? Delta.
Right. The total delta of a short straddle usually starts very close to zero. That makes it truly delta neutral, truly non-directional right when you put it on.
Okay.
A strangle's initial delta might not be exactly zero. It depends on how far out of the money you choose your strikes and if there's any skew in the volatility pricing between calls and puts.
And what about sensitivity to changes in volatility itself? Vega.
Good question. Vega, the sensitivity to changes in implied volatility, is typically higher for a straddle when you first put it on compared to a strangle.
Higher Vega. So if implied volatility suddenly spikes after you've entered the trade, a straddle is going to show larger paper losses than a strangle, at least initially, assuming the price hasn't moved much yet.
Yes, that's generally correct. And this contributes to what the source mentioned, potentially high mark-to-market, or M2M, swings right after you deploy a straddle.
Mark-to-market just being the current paper value of your position.
Right. It's not a realized loss unless you actually close the trade, but seeing your position value swing wildly on paper can be unsettling. But holding the position, especially if volatility does start to drop like you expect, can decrease that Vega sensitivity over time.
Okay, so straddles are more sensitive to IV changes initially. What about that point in the source about straddles performing better in certain market conditions?
Yeah, the IJPA source mentions that straddles are often said to give better returns in sideways or choppy markets compared to strangles.
Okay.
And like we discussed, straddles are particularly good candidates for putting on before those major events where you expect IV to be really inflated and then crash afterwards.
All right, let me try and summarize the comparison then. Short straddle, you get more premium up front, potentially easier adjustments because of that buffer. It targets peak time decay directly. It's delta neutral initially, but it has higher initial Vega sensitivity, leading to potentially bigger M2M swings if IV jumps unexpectedly.
Good summary so far.
Short strangle uses OTM strikes, so you collect less premium, meaning a smaller maximum profit. but the price has to move more just to get outside your initial profitable range defined by the strikes themselves before even accounting for the premium collected.
Correct. The initial strike range is wider.
However, that point in the source saying straddles have a wider break-in range than strangles. That seemed counterintuitive and potentially wrong, because a strangle's break-evens, strike plus minus the total premium, are typically further apart, giving a wider price range where you can still profit, even if the max profit zone between the strikes is narrower.
I agree. That specific comparison point in the source seems questionable and contradicts the typical understanding and payoff structure. A strangle generally gives you wider break-evens. We should probably rely on the formulas and the payoff shapes we discussed rather than that specific, potentially erroneous comparison point from the source.
Okay, good call. So let's focus on the core mechanics. Straddles are maybe more aggressive, closer to the money, higher premium, tighter initial strike range. Strangles are a bit less aggressive, further OTM, lower premium, wider initial strike spread, and usually wider break-evens.
That's a much clearer way to think about it.
But regardless of which one you choose, straddle or strangle, the potential profit is limited to the premium collected, and the potential loss is
unlimited.
Unlimited. Yeah. That's the elephant in the room, isn't it?
It absolutely is. And it brings us squarely to the critical section on risks and drawbacks. That unlimited loss potential, it just cannot be overstated.
Right.
If the underlying asset makes a significant, unexpected move way up or way down, the losses can be devastating. They can theoretically exceed your initial investment, even your entire account value if margin is involved.
And this isn't just some abstract theoretical risk, is it?
Yeah.
The sources mentioned some pretty major historical blowups.
They do. The ID's RepEx source points specifically to the collapse of Barings Bank back in 1995. That was largely due to a single trader's massive, unhedged short option positions going bad.
Wow.
And then there was the near collapse of the huge hedge fund long-term capital management, LTCM, in 1998. Their strategies also involved effectively selling volatility combined with a lot of leverage.
LTCM, I remember that. Required a massive bailout coordinated by the Fed, didn't it?
It did. And these are really stark reminders that unexpected extreme market movements do happen. They're often called tail events or black swans, and they can absolutely wipe out firms or individuals who are employing these kinds of strategies without enough capital or proper hedges in place.
Those historical examples make it chillingly real. Okay, besides the catastrophic unlimited loss potential, what other specific risks should someone be acutely aware of?
Well, a big practical one is the significant margin requirements. Because your potential loss is unlimited, your brokerage firm isn't just going to let you put these trades on without collateral. They require you to maintain substantial capital in your account as margin.
To cover potential losses.
Exactly. To cover potential adverse moves. This amount is often called buying power reduction, or BPR. For naked straddles or strangles, the BPR can be very, very high. It can tie up a large percentage of your trading capital.
So even if you have, say, $100,000 in your trading account, putting on just one naked strangle on a reasonably volatile stock or ETF might tie up, what, $20,000 or $30,000 of that buying power just for that one trade.
Easily. Sometimes more, depending on the volatility in the underlying. And that capital is then completely unavailable for any other trades you might want to make. It really limits your flexibility.
Okay, ties up capital. What else?
Then there's the implied volatility risk we touched on earlier. A sudden, unexpected spike in implied volatility may be due to breaking news, some geopolitical event, or just a general wave of market fear. That spike will increase the theoretical value of the options you sold, even if the underlying price hasn't actually moved dramatically yet.
Wait, so even if the stock price stays comfortably within my break-even points, if IV jumps up, my paper profit shrinks, or maybe even turns into a paper loss?
Correct. Those mark-to-market M2M swings we mentioned can be really large and happen very suddenly, particularly with straddles right after you enter the trade because of their higher vega.
Okay.
And while these are technically paper losses until you close the position, they can trigger margin calls if your account equity falls below the required maintenance margin level set by your broker.
And margin calls are seriously stressful situations, right? Your broker basically demands you deposit more funds immediately, or they can just force liquidate your position, maybe at the worst possible price, to protect themselves.
Precisely. It's a scenario every short option seller dreads. And this volatility in your account value, these big P&L swings, it can also have a really significant psychological impact. It can make it incredibly difficult to stick to your trading plan when you're facing large drawdowns on paper.
Yeah, fear kicks in. What about holding these overnight?
That's another big one. You face high overnight risk. Major news, unexpected events, those black swan things, they often happen when the markets are closed.
Right.
That can lead to huge price gaps when the market opens the next morning. A gap could immediately push your position deep into losing territory before you even have a chance to react or adjust.
Ouch. And just fundamentally, these are non-directional strategies. What happens if the market stops being calm?
Yeah, they're inherently unsuitable for markets that suddenly start trending strongly in one direction. If you put on a strangle expecting calm and the market decides to just rip upwards for 5 days straight, you're going to be in a world of hurt.
So they just don't work on trending days?
Absolutely not. You need to be prepared for what happens when the market decides not to cooperate and stay range-bound. Finally, there's also this ongoing academic debate about how predictable realized volatility actually is.
Meaning, the core idea that IV usually overestimates RV might not be universally true.
Well, while the idea that IV often overestimates RV is the theoretical edge these strategies rely on, the research isn't entirely settled. The IRIS source actually mentions studies that have conflicting findings on whether 5e is truly a consistently good predictor of future RV.
So the very premise that implied volatility is reliably too high isn't some kind of guaranteed constant law of markets.
It appears IV tends to bias towards overestimation. Yeah, there seems to be a persistent premium, but it's definitely not a perfect forecast, and it doesn't hold true in all market conditions or timeframes.
Okay.
And as the IRP source points out, citing some research, even if IV seems higher than historical or expected RV, any potential trading gains you might calculate could easily disappear once you factor in real-world trading costs.
Like commissions, fees, slippage on getting your orders filled.
Exactly, all those frictional costs. And you also have to consider the inherent cost, or risk premium, you should demand for taking on that unlimited risk in the first place.
Right. And didn't one source add another layer to that? Something about market risk premia.
Yes, the ideas Repec source has a really interesting point. It suggests that the decision to sell volatility shouldn't just be based on comparing IV versus your expectation of RV. You also need to consider other market premia.
Like what?
For example, if the underlying asset itself has a positive risk premium, meaning investors generally expect higher returns for holding it, like they do for stocks over bonds.
Okay.
And if that asset's returns are negatively correlated with volatility changes, meaning its price tends to fall when volatility spikes, which is often true for stocks.
Right. Markets often drop during panics when vol spikes.
Exactly. Then option prices might naturally be higher than predicted solely by expected volatility. Why? To compensate option sellers for taking on that nasty combination of risks, the risk of losing money when the underlying drops and volatility explodes simultaneously.
Wow. Okay. That's deep. So the premium you collect isn't just a simple bet on IV being higher than RV. It's also partly compensation for taking on the risk that things blow up exactly when you least want them to, like when the market's crashing.
That's a great way to think about it. It's not just a mathematical edge, it's potentially compensation for bearing that tail risk, the risk of extreme negative events.
Right.
And all this complexity means it's definitely not a simple strategy where you just look for high IV and blindly sell options. There's a lot more going on under the surface.
Okay, so summing up the risks. Unlimited loss potential, stark historical examples, significant capital tied up in margin, big M2M swings from IV changes possibly leading to margin calls, overnight gap risk, doesn't work in trends, and even the core IVRV edge isn't guaranteed and might be partly compensation for bearing other risks. Wow.
It's a sobering list.
It really is. So, despite all of that, do these strategies actually show positive returns in the real world over longer periods? The sources included some studies looking at this, right?
Yes, they did. A particularly widely discussed study, which was referenced quite a bit in that Reddit thread we looked at, was done by Tasty Trade. They examined the performance of short strangles on SPY.
SPY being the big S&P 500 tracking ETF. Very common for these kinds of trades in the U.S.
Exactly. They looked at both 16 delta and 30 delta short strangles over a pretty long period, from 2005 to 2017.
And just quickly, delta here is being used as a proxy for how far out of the money the strikes are. Lower delta means further OTM.
Correct. A 16 delta option is further OTM, generally considered safer, but collecting less premium than a 30 delta option.
Okay. And what was the methodologies in this study? How did they simulate trading?
The methodology was basically to open a new short strangle position every month, targeting options with approximately 45 days to expiration, or DTE. That's a pretty standard time frame many volatility sellers use.
45 days out. Okay.
Now, what's noteworthy, and the Reddit discussion really highlighted this, is that this specific study included trades entered regardless of the current implied volatility rank, or 5 rank.
5E rank?
Yeah.
That tells you if current IV is high or low compared to its own recent history.
Exactly. It's a percentile measure, usually 0 to 100. Tasty Trade, the firm that did the study, typically recommends only entering these short premium strategies when IV rank is high, say above 30 or even 50.
Why high V rank?
Because the theory is that higher 5e is statistically more likely to overestimate future RV, giving you a better edge, and the higher premiums provide a larger buffer against losses. So, this study, by including all IV ranks, even low ones, was actually testing a broader, perhaps less optimal set of entry conditions than typically recommended.
Interesting. So it might actually represent a more conservative look at the strategy's performance, since it wasn't just cherry-picking the supposedly best high IV entry points. What were the results then?
Well, across both the 16 delta and the 30 delta strangle levels, the study found an average return on capital, or ROE, of 0.07% per day.
0.07% per day. That sounds incredibly tiny on its own.
It does seem small day to day, but how does that translate annually? If you compound that 0.07% daily return over a full year, it actually works out to an annualized return of over 25%.
Over 25% a year? That sounds really good. Yeah. Too good. What's the catch?
The catch is that 25% assumes you could allocate 100% of your capital to these trades every single day, constantly earning that 0.07%. But as we just discussed with margin requirements.
Right, the buying power reduction, BPR. You can't allocate 100%.
Exactly. You need a significant chunk of your capital held aside as BPR to support the unlimited risk nature of the trade. Tasty Trade themselves recommend using no more than maybe 55% to 60% of your total buying power for these kinds of undefined risk trades, precisely to manage that tail risk.
Okay, so maybe half your capital is tied up or reserved.
Or even less. The Reddit user who performed the comparison in the thread we looked at assumed a more conservative average capital allocation of just 35% of a portfolio's buying power being actively used for this Strangle strategy over the period studied.
Okay, 35% allocation. So taking that impressive 25% annualized return figure, but applying this more realistic 35% capital allocation assumption, what does that do to the actual return on the total portfolio capital?
Well, if you take 25% annualized return potential multiplied by a 0.35 capital allocation, that brings the effective annual return on the entire portfolio down to roughly 9% per year. And that's before considering taxes.
9% per year before taxes over that 2005-2017 period.
Yeah.
Okay, still respectable. How did that actually stack up against just buying and holding the SPY ETF itself over that same period? Did they compare?
They did. According to the comparison provided in that Reddit thread, if you had invested $100,000 in SPY at the start of 2005 and just held it, reinvesting all the dividends, by the end of 2017, your investment would have grown to $287,220.
Okay, buy and hold SPY turned $100 into about $287K.
Right. Now, the short Strangle strategy, starting with the same $100,000 and assuming that 35% average BPR allocation throughout the period, reportedly ended the period at $306,580. Again, that's before taxes.
Wow. Okay, so according to that specific study and the user's comparison, the short Strangle strategy, even without filtering for high IV rank entries and using a fairly conservative capital allocation, actually slightly outperformed simple buy and hold SPY over that 12-year period.
That's what the numbers suggested, yes.
That is compelling. It suggests that maybe there really is something to this idea of systematically harvesting that volatility risk premium over the long term.
It certainly provides evidence that the strategy can potentially generate positive returns over time, even beating the market in this specific time frame and simulation.
Right.
However, and this is a big however, the discussion in that Reddit thread provides absolutely crucial context.
Like what?
Well, many experienced traders commenting pointed out that achieving that kind of return involves, and I quote, a ton of work.
A ton of work.
Yeah. Constant monitoring of your positions, managing trades that go against you, dealing with the stress of those big M2M swings we talked about,
right,
making adjustments. It is absolutely not passive investing. It's very active management.
Right. It sounds like a demanding job, not a casual hobby.
Definitely. Others in the thread discussed ways you could potentially improve the return on capital, the ROCE. For example, using leveraged futures contracts like the MES, which is the Micro E-mini S&P 500 future.
Futures track the same index but have different margin rules.
Different margin requirements, yes, often more capital efficient, but importantly, as we'll discuss later, they also have a very different tax treatment, which can significantly impact your bottom line. So again, the specific instrument you trade matters hugely.
And what about that idea of holding the unused 65% of your buying power in something else?
Yes, that's a critical portfolio management point that came up. If only 35% of your capital is tied up on average in the BPR for your Strangles, what are you doing with the other 65%? It shouldn't just be sitting there doing nothing.
Right.
You could and probably should hold it in very low risk, highly liquid assets. Things like short duration government bonds or treasury bills, or maybe just a money market fund.
So that unused capital is earning something, however small, and it's readily available.
Exactly. While that 9% calculated return was on the total capital, including the unused portion, actively investing or at least holding interest-bearing assets in that unused 65% could potentially boost the overall portfolio return even further. And crucially, it also provides that readily available cash buffer you need against potential margin calls if things go sour temporarily.
Okay, that makes a lot of sense. It's a reminder that the strategy doesn't exist in a vacuum. It has to be part of a larger portfolio and capital management plan.
Absolutely.
And we should probably reiterate the limitations of that tasty trade study too, right? It didn't simulate every possible way a trader might adjust a losing trade. It only modeled taking profits at 50% of the max potential.
Correct. And as we mentioned, it didn't apply that commonly recommended high IV rank entry filter. So the results might look different, maybe better, maybe worse, depending on the specific management rules you use.
Okay. What about the SigTech backtests mentioned in the sources? Did they offer a different perspective? They were looking at using market-wide volatility signals, weren't they?
Yes. The SigTech source explored using the VIX index, which is often called the market's fear gauge. It's basically the implied volatility of S&P 500 options as a trading signal.
Okay.
They showed a concept of a mean reversion strategy. The idea is that the VIX tends to spike during panics, but then usually reverts back down towards its average level. So you might initiate volatility selling trades when the VIX spikes significantly above its moving average, betting it will eventually fall back down.
Sell volt when fear is high, basically.
Pretty much. They presented some back-tested performance graphs for various options strategies, including Straddles and Strangles, in 2020 and 2022, two very different and quite volatile market years.
Right. 2020 had the COVID crash and recovery. 2022 had the Fed hiking rates and persistent inflation fears. What did their backtest show about Straddles and Strangles in those specific volatile periods?
Interestingly, the SigTech backtest noted that in 2022, which was a period of significantly higher and more sustained implied volatility compared to the generally low IV environment of many preceding years. In that higher 5E environment of 2022, the undefined risk strategies like the short straddle and short strangle generally outperformed the defined risk strategies like iron condors and iron butterflies in their specific simulations.
Outperform the defined risk versions. Why would that be?
Well, it aligns perfectly with the core idea of selling premium when volatility is elevated. The higher the 5E, the more premium you collect up front, especially for those undefined risk strategies. And if that high IV then falls, or if the actual market movement RV turns out to be less than what that high V was predicting,
then those bigger premiums you collected can translate into better performance.
Exactly. Even though the market environment itself was more volatile, the potential reward from selling that overpriced volatility was apparently greater for the undefined risk strategies in their test for 2022.
Okay, so that reinforces the idea that these strategies can potentially shine, maybe even relative to their defined risk cousins, specifically when implied volatility is high.
It seems to suggest that. But SigTech also strongly emphasizes that the performance is incredibly sensitive to the exact trading parameters you use.
Like which strikes you pick, which expiration cycle, when you enter, when you exit, how you adjust.
All of that. Tiny changes in the rules can lead to very different results. It really requires robust scenario analysis and testing before you'd want to rely on any specific approach.
Which brings us right back around to the absolutely critical point, managing the risks. With that unlimited loss potential lurking, you need more than just a potentially profitable edge. You desperately need a survival strategy.
Absolutely. Risk management isn't just a footnote here. It's arguably the main chapter. If you don't get risk management right with these strategies, you likely won't be trading them for very long.
Okay, so what are some of the key mitigation strategies that the sources discussed? How do people try to control this beast?
Well, one fundamental technique mentioned in the Bajaj broking source is setting stop-loss orders.
Defining your maximum acceptable loss beforehand.
Exactly. You decide before you even enter the trade. If this position loses more than X dollars or reaches price Y, I am out. No questions asked. And you put an automatic order in place with your broker to close the position if it hits that level.
So you define your uncle point before emotion can take over. That helps prevent a manageable loss from snowballing into a catastrophic one.
That's the goal. Although we should mention stop-loss orders aren't absolutely guaranteed fills, especially in really fast-moving, chaotic markets. You might get filled at a worse price than your stop level. That's called slippage.
Right. Slippage is a risk, but having a stop is still better than having nothing.
Generally, yes. It's a crucial safety net. Another key technique is actively managing the position through adjustments. If the underlying asset price starts moving strongly towards one of your break-even points, you don't necessarily just sit there and hope it reverses.
You do something. What kind of adjustments are we talking about?
Well, you might roll the position. That typically means closing your current options that are under pressure and simultaneously opening new ones, maybe with later expiration dates, to give the trade more time to potentially work out. Or maybe you roll to strikes that are further away from the current price, effectively widening your break-even range again.
Buying yourself more time or more room.
Exactly. Or another common adjustment is to convert the undefined risk position into a defined risk one.
How do you do that?
You basically buy options further out of the money to cap your potential loss. So if you had a short strangle on, you could buy a put even further down and a call even further up. That turns your short strangle into what's called an iron condor.
Ah, putting wings on it.
Precisely. Or you could do something similar with a short straddle, turning it into an iron butterfly. The key is your buying protection, defining your maximum possible loss, albeit at the cost of reducing your maximum potential profit, because those long options cost money.
Okay, so actively monitoring and being willing and able to modify the trade as market conditions change seems absolutely essential. You mentioned defined risk strategies like iron condors and iron butterflies. How do they compare more broadly as alternatives?
Well, their main advantage is obvious. They cap your maximum potential loss right from the start. That maximum loss is typically the difference between your short and long strike prices minus the net premium you collected. It's known up front.
Which psychologically must be much more palatable for many traders, right? Knowing the absolute worst case scenario beforehand.
Hugely. It removes that terrifying unlimited loss aspect, which is a major barrier for many people considering short option strategies. It makes the risk defined and manageable.
Sounds much safer, especially concerning those tail risks, those black swan events. So what's the trade-off? Why doesn't everyone just trade iron condors instead of naked strangles?
The trade-off comes in a couple of forms. First, buying those protective wing options costs money. That cost directly reduces the net premium you collect when you initiate the trade.
So lower maximum potential profit compared to the strangle.
Yes, significantly lower max profit potential, typically. Second, according to one Tasty Trade study that was cited in the Reddit discussion, while iron condors do cap your risk, they might actually have a lower probability of achieving any profit compared to the uncapped strangles.
Lower probability of profit. Why is that?
Likely because for an iron condor to achieve its maximum profit, the price has to stay within a potentially narrower range, specifically between your short strikes at expiration. And your profit starts decreasing as soon as the price moves outside the wings you purchased, whereas the strangle still has profit potential further out until its break bends. So the profit zone might be shaped differently and perhaps statistically harder to hit perfectly.
Okay, interesting. So capped risk often comes with the trade-off of less profit potential and maybe even a lower chance of winning the trade itself. It really is a fundamental risk versus reward decision point for the trader.
Exactly. There's no free lunch. Another vital risk management technique, which was highlighted really well in the Reddit thread, is responsible capital allocation and maintaining that cash buffer we talked about.
Right, not putting too much capital in any one trade or strategy.
Precisely. Given the high BPR requirements and the very real possibility of large M2M swings triggering margin calls, keeping a significant portion of your portfolio's capital, maybe 40%, 50%, even more in highly liquid, safe assets, is critical.
Like those short-term T-bills or money market funds again.
Yeah. That cash isn't just sitting idly by being unproductive. It's your defense capital. It's the money that's readily available to meet margin calls during temporary drawdowns, preventing your broker from forcing you to liquidate positions at the worst possible time. It keeps you in the game.
That makes intuitive sense. You absolutely need reserves for when things inevitably go wrong, even if only temporarily. What about understanding the Greeks beyond just delta and vega? Are others important for sellers?
Oh, absolutely. Gamma is particularly important, maybe even treacherous for short option sellers, especially as expiration gets closer.
Gamma. What does that measure again?
Gamma measures how much an option's delta changes for every 1 point move in the underlying asset's price. Think of it as the accelerator for delta.
Okay. For options that are near the money, like in a straddle, gamma is highest. And as expiration approaches, gamma absolutely explodes. It gets huge.
Why is that bad for a seller?
Well, if you are short a straddle or a strangle, and the market starts moving significantly towards or even past one of your short strikes right near expiration when gamma is massive, your position's delta can change incredibly rapidly.
Meaning your initially non-directional position suddenly becomes very directional very fast.
Exactly. It can suddenly take on a huge directional bet against you, accelerating your losses dramatically. This gamma risk is why trading very short-dated options, like weekly options, using undefined risk strategies like straddles or strangles, is often described as extremely dangerous, like picking up pennies in front of a steamroller. The gamma risk near expiration is enormous.
So that's why many experienced option sellers prefer to enter trades with, say, 30 to 60 days to expiration, as that Reddit source recommended, to avoid that crazy end-of-life gamma explosion. Yes, exactly. Starting with longer DTE means gamma is much lower initially. It gives you more time for the price to stay in your desired range, or for time decay, theta, to work its magic, before gamma starts increasing dramatically in those final days or weeks leading up to expiration. It gives you more time to manage the position.
Okay, so rigorous risk management, using stops, making adjustments, considering defined risk alternatives, managing capital allocation and buffers, and deeply understanding the Greeks like gamma is absolutely non-negotiable for survival here.
Couldn't have said it better myself.
Now let's shift gears slightly to something that can also dramatically impact your actual take-home returns. Taxes. The SIBO source had some really crucial points on this, didn't it?
Oh, this is absolutely critical, especially for anyone thinking of actively trading these strategies frequently in the US. The tax treatment of your option gains can vary significantly based on the type of underlying asset you're trading options on.
Okay, how so?
There's a major distinction between trading options on broad market ETFs, like the popular SPY, and trading options directly on broad-based indices, like the S&P 500 index itself, ticker SPX, or the mini SPX index, ticker XSP.
SPY is an ETF, SKX, XSP are indices. How do they differ in terms of taxes?
Okay, so for options on ETFs like SPY, QQQ, IWM, etc., any gains you realize, whether it's from the underlying moving favorably, less likely for sellers, or more typically for sellers, from profiting as the premium you sold decays away, those gains are generally taxed as short-term capital gains.
Short-term capital gains, meaning they're taxed at your ordinary income tax rate.
Correct. Taxed at your ordinary income tax rate, which, depending on your overall income bracket, can be quite high. The SIBO source noted that back in 2019, the top federal rate was 37% plus potential state taxes.
Ouch. So if you're actively trading these volatility selling strategies on SPY and doing reasonably well, a very large percentage of your gross profit could just disappear to the tax band at your highest marginal income rate.
Exactly. It can take a huge bite out of your net take-home returns. It significantly impacts the attractiveness of the strategy's profitability.
However, there's a better way.
There might be. Certain exchange-traded, broad-based index options, specifically including ones like SPX, the mini SPX XSP, the Russell 2000 Index, RUT, and the mini RUT, MRUT, may qualify for much more favorable tax treatment under Section 1256 of the U.S. Internal Revenue Code.
Section 1256. Okay, what does that mean in practice? How are they taxed differently?
What it means is that gains and losses on these qualifying Section 1256 contracts are typically treated as 60% long-term capital gain or loss and 40% short-term capital gain or loss.
60% long-term, 40% short-term.
Yes. And crucially, this blended 60-40 rate applies regardless of how long you actually held the option position.
Wait, even if you opened and closed the trade on the same day, it still gets 60% treated as long-term gain.
That's the rule for Section 1256 contracts. The holding period doesn't matter for the 60-40 split.
Wow. That seems like a huge potential advantage because long-term capital gains tax rates are significantly lower than ordinary income rates, aren't they?
They are, much lower. In that 2019 example SIBO used, long-term rates range from 0% up to a maximum of 20% compared to ordinary income rates up to 37%.
Can you walk through their example? How much difference did it make?
Sure. The SIBO source gives a really powerful example. They imagined an individual trader in the 35% marginal ordinary income tax bracket who made $15,000 in taxable trading profits during the year.
Okay, $15K profit.
If those profits came from trading SPY options, the ETF, they'd be taxed as ordinary income at 35%. So the tax bill would be $15,000.35 equals $5,250.
Okay, over $5,000 in taxes.
Now, if that same $15,000 profit came from trading qualifying SPX or XSP options, the indices that fall under Section 1256, the tax calculation changes. 60% of the profit, $9,000, would be taxed at the long-term rate. Let's assume the max 20% for this example. And 40%, $6,000, would be taxed at the short-term ordinary rate, 35%.
So the tax would be 0.6 15K, 20% plus 0.4 15K, 35%.
Exactly, which is $9,000.20 plus $6,000.35, $1,800 plus $2,100 in total taxes.
$3,900 in taxes instead of $5,250.
Yes, that's a tax saving of $1,350 on just $15,000 of profit, simply by trading options on the index, SPX, XSP instead of the ETF, SPY.
That $350 difference is massive. It's almost 10% of the profit itself. It really underscores that the venue or the specific type of option contract you trade can be just as important as the trading strategy itself when it comes to your actual net after-tax profitability.
It absolutely can be. For active traders, that tax difference could easily be the difference between a mediocre trading year and a really good one. It is absolutely imperative, though, for anyone considering this to consult with a qualified tax advisor about their specific situation and to confirm exactly which instruments qualify for Section 1256 treatment. Tax laws can change.
Good disclaimer. Always talk to a tax pro. Does the SIBO source mention any other differences between trading ETF options like SPY versus index options like SPX or XSP?
Yes, it does. Another important difference that impacts traders is their exercise style.
Exercise.
ETF options like SPY are typically American style. That means the buyer of the option can choose to exercise their right to buy for calls or sell for puts the underlying shares at any time before the expiration date.
Okay, they can exercise early.
Index options like SPX and XSP are typically European style. That means they can only be exercised right at expiration. They cannot be exercised early.
And why does that matter to an option seller? Early assignment sounds like a headache, right?
It definitely can be. If you are short a call option on an ETF like SPY and the stock goes ex-dividend, the call buyer might exercise early to capture the dividend, forcing you to deliver shares you might not own, creating a short stock position unexpectedly. Or if you're short a put on SPY and the stock price falls sharply, the put buyer might exercise early, forcing you to buy the shares from them, again, perhaps unexpectedly tying up capital. Index options like SPX avoid this whole early assignment risk because they simply cannot be exercised before expiration.
That sounds operationally simpler.
It generally is. Also, related to that, index options like SPX and XSP settle in cash at expiration based on the index's final settlement value. There is no delivery of shares involved. ETF options like SPY, on the other hand, settle via physical delivery of the underlying ETF shares if they are exercised or assigned. That adds another layer of operational difference and potential complexity, especially if you don't actually want to hold the ETF shares.
Okay, so taxes are potentially much better with index options, and operationally, they might be simpler too, due to European-style exercise, no early assignment, and cash settlement. These are definitely not minor details. They sound like crucial factors in deciding which instrument to actually use for these strategies.
They absolutely are. Ignoring these differences means you could be leaving significant potential profit on the table due to higher taxes, or exposing yourself to unnecessary operational risks and complexities with early assignment and physical settlement.
Got it. So bringing this all back around now, the fundamental engine that's supposed to be driving the potential profitability of selling straddles and strangles is that persistent difference or expected difference between implied volatility and realized volatility.
Exactly. It's back to that horse race analogy. The market's prediction versus the actual finish time RV. And understanding why your trade ultimately made or lost money really requires analyzing whether the market's expected volatility, the IV that was embedded in the option premium you sold, turned out to be higher or lower than the volatility that actually occurred, the RV, during the life of your trade. As PredictingAlpha.com stated quite clearly, when you trade options, you are fundamentally trading volatility. That's the real underlying exposure.
And the goal then of the volatility seller is specifically to find those situations where they believe implied volatility is, for some reason, artificially inflated, or at least likely to significantly exceed the actual future price movement they anticipate.
Yes, that's the core thesis. And market conditions play a huge role in creating those potential opportunities. Periods of high uncertainty, maybe anticipation of major news releases, or just general market panics. Those conditions cause VIV to spike as traders rush to buy options for speculation or, more often, for hedging portfolio risk.
And conversely, stable, calm, boring market periods tend to see IV decrease.
Generally, yes. So the opportunities for sellers often arise when you anticipate a shift in these conditions. For example, selling premium heavily when IV is historically very high because you expect a return to calmer conditions, lower RV, perhaps after a specific event passes or a period of fear subsides.
So it seems like success with these strategies isn't just about passively hoping for a quiet market day after day. It's much more about strategically entering trades when the market's prediction of future volatility, the 5, appear significantly higher than what your own analysis suggests the actual volatility RV is likely to be.
Right.
And crucially, having robust plans in place to manage the risk involved in case your analysis turns out to be wrong or the market does something completely unexpected.
Exactly. You're trying to systematically monetize that potential overestimation of risk by the market while simultaneously taking on the risk that the market might actually underestimate it or that a true black swan event occurs. And as all the sources really indicate, while the core concept sounds fairly simple on the surface, successfully executing it consistently requires sophisticated analysis, disciplined execution, and truly robust risk management. It's not easy.
This has been a genuinely deep dive.
Well,
we've covered a ton of ground here. We explored the core concept of selling volatility, specifically using short straddles and short strangles. We looked at how they're constructed to try and profit from quiet markets by collecting option premium. We spent a lot of time on the substantial, potentially unlimited risks, involved risks that require serious respect and management.
Absolutely critical.
We looked at some real-world study results comparing their historical performance, which surprisingly showed potential outperformance against buy and hold in some cases, but with major caveats.
Right. The work involved, the allocation needed.
Exactly. We discussed absolutely essential risk management techniques needed just to survive unexpected market moves, stops, adjustments, define risk alternatives, capital buffers, understanding gamma.
The whole toolkit.
And we highlighted how crucial, yet often overlooked, factors like taxes especially, that Section 1256 distinction and operational details like exercise style can dramatically impact your actual net profitability.
Yeah, the key lessons here are definitely multifaceted, but I think they're pretty clear. While strategies like short straddles and short strangles can be potentially profitable tools in the trader's arsenal, especially perhaps in range-bound markets or when implied volatility is unusually elevated, they come hand in hand with significant, potentially catastrophic risk. They are absolutely not strategies for the undercapitalized, the inexperienced, or the faint of heart.
Right. Success doesn't just hinge on getting lucky and predicting a calm market. It sounds like it's really about having a robust, repeatable process.
Absolutely. Success seems to require rigorous risk management above all else. It requires a deep understanding of volatility dynamics, that IV versus RV relationship, and the option Greeks like delta, vega, and especially gamma. It demands constant awareness of crucial factors like margin requirements and the very real psychological impact of those M2M profit and loss swings. And critically, as we saw, it requires understanding how taxes and the specifics of the instrument you trade, like Section 1256 eligibility for index options versus ETF options, can literally make or break your net returns over the long run. It's a very active, demanding, high-stakes approach to trading.
Okay, so what does this all mean for you, the listener, as you think about potentially incorporating these kinds of strategies? Here's maybe the provocative thought to leave you with. Given the potential for decent returns that some studies suggest, but balanced against that ever-present looming threat of unlimited loss, especially during those unpredictable volatile events like the market crashes the sources mentioned, does the potential reward of selling volatility with all the intense work, constant monitoring, and rigorous risk management it clearly entails truly justify taking on that undefined risk for your specific situation?
Or perhaps our defined risk strategies, things like the iron condors or iron butterflies we touched on, even with their potentially lower returns, a more prudent and manageable path to explore first, especially as you learn and gain experience in the options market.
That really is the essential question, isn't it? Each individual trader has to grapple with that, honestly weighing the potential benefits against the very real costs and dangers, and aligning any strategy with their own financial situation, their capital base, and crucially, their personal tolerance for risk.
Couldn't agree more.
Something to definitely consider carefully as you navigate the markets. Well, thanks for joining us on this deep dive into the complex world of selling volatility. We really hope this exploration has given you some valuable insights to help inform your own thinking and trading decisions.
And until next time, stay informed, manage your risk, and trade wisely.